Hello, and welcome to the EY Taulia Working Capital Game Changer series and webinar, Sizing the Prize, How Artificial Intelligence Enables You to Accurately Size the Working Capital and Yield Opportunities in Your Supply Chain. My name is Amrita, and I'm the Director of Marketing at Taulia. I'm joined today by two of industry's subject matter experts and working capital game changers, Nick Boaro, Working Capital Partner at EY, and Vincent Bierman, Director of Product at Taulia. Would you both like to say a quick hello and introduce yourself?
Thanks, Amrita. This is Nick Boaro. I'm a partner in our Working Capital Advisory Services practice at EY. That's a team of the largest dedicated global practice of folks that do nothing but working capital and cash flow. So it's a very, very specialized, dedicated team, and looking forward to the conversation today.
Good morning. My name is Vincent Bierman. As Amrita said, I'm Director of Product in charge of our data, AI, and analytics products, and also looking forward to sharing with you a little bit about what we do here at Taulia and learning from you guys as well.
Fantastic. Thank you very much. So before we get started, let's get some quick housekeeping things taken care of. First of all, this is a great opportunity for you to ask the questions today and get the information you seek. So please feel free to use the question box below on your screen. Secondly, the Q&A session will take place in the last 10 minutes before the webinar ends. And then finally, our hashtag today is hashtag WCGameChangers. So let's get live, get involved, and get the conversation started on LinkedIn and Twitter. So what is the agenda for today? What are we going to talk about for the next 45 minutes or so? Well, cash continues to be a board-level agenda item, whether it is freeing up working capital from operations, earning stronger returns, or improving supply chain health. Nick will be diving in deeper details shortly on how working capital processes deliver more than just cash flow benefit, and that sizing the prize is not a one-size-fits-all approach. We will then be talking about the artificial intelligence and how it allows companies to gain true visibility into the cash opportunity. Vincent Bierman will be presenting a demo on Polaris, Taulia's own AI-enabled tool, and how it allows companies to build scenarios to optimize working capital, yield, and supply chain health. And finally, we will be talking about the next practical steps that you can take within your role and in your organization to accurately size the price, and how can Taulia and EY collectively help you get there. So with that said, I'm going to open the floor to Nick, who will be talking to us today about how working capital processes deliver more than just cash flow benefit and how it applies to organizational goals. Over to you, Nick.
Thanks, Amrita. So working capital, we call it not a one-size-fits-all approach. So when I think about working capital or why working capital is important, historically, our clients have been focused on releasing the cash tied up in operations, a majority of our clients. So as a result, sizing the prize for those clients was actually quantifying the cash upside that they could pull out of the business. Today, what we're starting to see is, and just as a teaser for reference of sizing the prize later, the equivalent cash release value that we would typically identify and deliver was around 5% of sales. So quite sizable and quite an interesting topic of conversation. But while I believe cash flow and just generating more cash and holding it in your balance sheet is always going to be important and a relevant topic for conversation, it does depend on the goals of your organization as to what you're doing when it comes to working capital. So, when I look at it, just kind of going across the top of the page there, some of the goals some of our other clients have, other than driving incremental cash flow, is predicting and having the visibility to meet communicated guidance, improving organizational efficiency, and then also kind of the balance sheet efficiency. And I'll cover some of the benefits of each of those and how we size the prize differently on the following page for those different goals. But the same processes that impact working capital to generate incremental cash flow and the same activities you would deploy drive additional benefits as well. And some of those benefits include improved customer service, more efficient supply chain, margin improvement, which is always top of mind, and like I mentioned, that visibility and predictability of forecasted results. And that tends to be still a hot topic on almost every conversation I have today, whether or not the topic of generating more cash flow is top of mind. So I mentioned what relevant processes impact working capital. That, just to be crystal clear, the order to cash process, so how you're dealing with your customers. You're looking at your supply chain or your forecast to fill process. Then obviously your procure to pay process, which we'll dive into a bit deeper later today. When I always get the question, this is really relevant for distressed or stressed organizations, right? Just generating more cash out of operations. And the question is, yes, that absolutely is relevant there, but cash is relevant across the capital agenda. And I think many of our largest clients are actually mature organizations that have stockpiles of cash, and they're actually looking at how do we just run a more efficient business. And that's some of the aspects that we talk about when we talk about these working capital components. One of the topics today that is, I know, top of mind for probably most folks on the call is tax legislation. So when we're thinking through kind of the impacts of the recent tax legislation, there are a lot of companies that had stockpiles of cash, perhaps internationally, but domestic cash was short. And there was always a focus on how do we generate domestic cash, which that pressure no longer exists, having to repatriate some of that cash. Now that is not a U.S. organization or business issue only. For international organizations with operations in the U.S., this tax legislation obviously has a large impact as well. Some of the things that we see, current conversations on the board level, how are we thinking about our capital structure geographically? So with interest deductibility impacts, how are we thinking about where we're going to generate our capital and where we're going to deploy our capital? And I think that this is a conversation that, regardless of generating more cash, how you're generating and deploying capital is going to be a discussion, and working capital is going to be one of those key components that helps organizations manage where they're going to land. So moving on to the next slide here, those same organizational goals I mentioned earlier laid across the top, I wanted to talk a little bit about how we size the prize differently for each of them. So just so you can follow along, the green arrows there are what's happening to cash in that scenario, and I'll talk about some of the qualitative points. So obviously, generating incremental cash flow and improving cash and releasing cash tied up in operations is going to increase cash, so the arrow's going up. But this is not only a working capital-centric, trade working capital-centric opportunity. We're seeing this across the organization today, from benefits to real estate to what we call non-trade operations. What are we doing to generate incremental cash flow across the organization? That's historically been the primary focus, and sizing the prize is focusing on what's extracting the most amount of cash as quickly as possible, and it typically has the highest cash results of any of the different goals that you could be looking at. The next area is actually more about meeting communicated guidance. So it's not necessarily about generating all of your incremental cash in one quarter or 1 year. It's about knowing you have the levers to pull to generate incremental cash flow over time to meet your communicated guidance. So if you, let's say, delivered $100 million in Q1, and that's really one time, you might now have a $100 million hole or something you have to fill in Q2 if you didn't have a plan to go kind of deliver incremental cash flow. So what we're talking about there is one, do we know where we're going to land in a given quarter, which working capital tends to be the highly variable item that folks don't necessarily have visibility or control or predictability on. They do have control but don't know how to do it yet. So the levers that they're going to pull are what determine how much value you realize over time. So you're still generating more cash flow, but kind of up on an arrow because it's going to be released at a slower pace in line with meeting certain expectations. The next one around organizational efficiency. So I have a couple clients who are really focused on, they view themselves as leading class when it comes to, let's take order to cash, for example. And they're not necessarily looking to generate more cash flow from operations. They're actually want to make sure that they sustain the cash flow that they've generated, but want to look at the size of the team and how things are operating functionally that could release cost from that function. So this is where items like robotics and artificial intelligence also play a role, not only in sizing the prize, but in the solutions that get deployed to realize the benefits. Now, as you mentioned, as you can see there, the green arrow is going to the right, is there's no incremental cash flow, so sizing the prize is not going to be a cash-focused lever. It's going to be a margin and still customer service focused lever while maintaining the same cash performance historically achieved. And then finally, on the far right, we have what I've tagged as balance sheet efficiency, a number of different metrics that you can use to measure this, but I put an arrow down. It could go up, but effectively what we're talking about here is not just how are we generating cash flow or how are we running our business more efficiently. It's all of the above and potentially deploying capital to improve cost. And we'll dive into that in a little bit more. One great example is dynamic discounting, where you're deploying cash to generate an incremental return. And maybe you've used a strategy on the front end where you've pulled in or extended terms for certain suppliers and using that cash that you've generated there to deploy for incremental cost on the back end. So you're getting the best of both worlds where you're cost neutral, you're cash neutral, but you're cost favorable. We look at a lot of organizations today looking at all of these different levers. And the question, from before, why working capital is the processes that impact working capital and cash flow are relevant, whether you're going through the tax legislation right now, are relevant no matter what your goals are as an organization, but the opportunity size changes for each of those. So I wanted to hand off now to Vincent, who's going to do a deeper dive on artificial intelligence and the demo of the Polaris tool.
Thanks, Nick. I really appreciate it, and that was a great tee up to what we're going to talk about, from unlocking cash all the way through to deploying cash, depending on your situation and your balance and what your goals are. So I'd like to talk to you about how we think about the opportunities in your supply chain here at Taulia. And the questions that you might be asking yourself, or maybe should be asking yourself, is how much cash could I unlock, right? And the second question is maybe how much cash should I deploy? And those two aren't necessarily mutually exclusive. You may have some high yield opportunities to deploy some cash, and at the same time there may be some great opportunities currently in your supply chain to adjust terms and unlock some cash. And then the last question is always, how will these actions impact your suppliers? Obviously, your physical supply chain is crucial to your company's success, and you wouldn't want to do anything that could jeopardize that and delivery times and your own customer satisfaction. So the question is, could you get this data insight from your ERP system or your data team? And how long would that take? Could you get it today, or would it take a couple of days, a couple of weeks? Could you get it every day? Or is this kind of a one-time project to look at it and then you're again sort of putting the curtains up and flying blind a little bit? So that's what Taulia really helps our customers do, right? Is we look at every supplier as an opportunity as well as that source of risk on the physical side. So each supplier represents an opportunity potentially to unlock working capital. It presents a discount yield opportunity in terms of early payment yield, and they also have the supplier health element, both improving supplier health by offering low-cost financing to those suppliers so they can grow their own business and maintain a healthy balance sheet, as well as the supplier health risk, which is extending terms too far and putting your suppliers at risk of not being able to deliver or even going out of business. So let's talk a little bit about the data that's required to assess each of these opportunities, right? It is a myriad data that would be needed to really dive in and look at these. So on the supplier side, you'd need to know the master payment term across every single one of your business units. You'd want to know the supplier's average DSO, particularly with customers like you. What's their expectation of what that payment term should look like? What's their cost of capital or cost of borrowing in the marketplace? What's their appetite for cash? Perhaps they're sitting on a pile of cash, or maybe they're struggling to make payroll at the end of the month. What does their quarter and year-end behavior look like? Are they managing to particular metrics? Do you see particular behaviors of accelerating payments near the end of the month or the quarter? Are they willing to take a longer payment term except in those critical times for them? And is this supplier a commodity supplier or strategic supplier is obviously something that's going to be important to your organization as you talk about this across the teams. And then on the invoice side, right, did you pay that invoice according to the master vendor payment term? Did you pay it on time? Could it have been accelerated? If it was offered, would it have been accelerated? And did you want it to be accelerated based on your cash needs at that time? So these are all questions that we ask our artificial intelligence engine all the time. And I've been a product manager long enough to know better than to do a live demo. So I recorded this last night, and hopefully all will go off well, and you guys will be able to hear this.
So let's take a look at how Taulia leverages our AI engine and the over $1 trillion worth of transactions in our dataset to provide you with the insights you need to optimize every supplier interaction. Every supplier is unique, and every relationship has dynamics that impact the payment terms and behavior of both parties. Because of the myriad factors that play into those dynamics, you really need machine learning technologies to decipher and recognize those complex patterns. How will a machine tool supplier in Germany react to a terms extension? Is a food supplier in Brazil likely to take an early payment? That's what Polaris does. It helps you recognize patterns in the data and returns specific recommendations that optimize working capital, discount yield, and supplier health. Let me show you how. This dashboard is a visualization of the AI that helps our buyers tune their programs every day. I imagine none of you has time to do a supplier-by-supplier analysis on tens of thousands of individual companies in your supply chain. That is why we built Polaris to automatically analyze and reanalyze every supplier relationship as they evolve. Let me show you how it works. The top section here represents a few of the growing number of factors our engine considers. Let's take a look at a large electronics supplier with a BB credit rating. Polaris helps you understand the two sides of the cash coin for this relationship and how your decision will impact your supplier's health. This is real data, by the way. Just the names have been anonymized for the purposes of this demo. In this case, the buyer is currently offering early payments at a 12% APR. The supplier has yet to accelerate any of those invoices. Perhaps the rate is too high, or the term is too short for the supplier to see significant value in accelerating, or perhaps we just haven't reached the decision maker yet. Let's first take a look at the discount yield opportunity. On the left-hand side in blue, you'll see this supplier's current behavior and the Polaris recommendation. What the machine learning algorithm finds in the data is that offering this supplier an 8.2% APR should result in an average of 28 days of acceleration on about 17% of the invoices. This would yield discounts around $1,000 for each $1 million worth of invoices offered. Not bad, but not great. By the way, this buyer has an 8% floor on their dynamic discounting program, so Polaris is considering the buyer's desired rate of return and liquidity thresholds in addition to the supplier's dynamics. On the right-hand side of the dashboard in the orange section, you see the distribution of early payment activity and recommendations Polaris made for similar suppliers across our network. As we scroll down, you can see in the next section, we're looking to see if you can unlock cash from the same supplier relationship. Because Taulia offers early payments using either the buyer's cash or third-party capital, we can make an SCF early payment offer to this supplier at a much lower APR. Based on the program parameters and the cost of capital for the SCF portion of this buyer's program, we can offer the supplier a 3.9% APR. Injecting this kind of cheap capital into your supply chain frees you up to unlock a lot of cash without burdening your suppliers. On the left side in blue, you can see that this supplier has an estimated cost of capital of 9.8%. We get this data from DNB and other sources, and our AI is able to impute these values for smaller, privately held companies. By extending the low-cost capital available to the buyer down to all levels of their supply chain, Taulia is helping buyers unlock hundreds of millions in cash without killing their suppliers. In this instance, you can see that the buyer can extend payment terms from 45 days to 90 days without impacting the supplier. The cost for the supplier to carry an invoice 45 days using their own cash is about $11,000 per million in spend. If the buyer extends the payment term of this supplier from 45 to 90 days, the supplier can accelerate that invoice using Taulia at a rate of 3.9%, and their carrying costs will remain at about $11,000 per million. By extending the supplier from 45 days to 90 days, this buyer unlocked $1.8 million in cash. Now, I know what you're thinking. Most suppliers will kick and scream if you ask to change their payment term from 45 days to 90 days. But after Taulia walks them through the math and explains that their carrying costs will be about the same, and in some instances even lower, most suppliers understand that helping their biggest customers unlock cash to grow their business will result in more orders for them. And with the SCF financing, the supplier can manage their own balance sheet to fill those bigger orders. At the bottom of the dashboard, you can see a summary of the options available. The first section shows business as usual, with the supplier carrying the existing term with their own cash. Line 2 shows the Polaris recommended APR of 8.2% with the existing term of 45 days. In this case, we expect the supplier to accelerate about 17% of their invoices an average of 28 days, which would net the buyer about $16,000 in annual discount yield. And the third row shows the opportunity to unlock $1.8 million in cash by extending the supplier to 90 days and allowing them to accelerate that using the low-cost SCF financing. Now that you understand how we use AI to analyze a single supplier, let's take a look at how this plays out across your entire supply chain.
So let's take a look at a particular case study for a buyer. This is a consumer products multinational. They're about $3 billion in spend. They've got roughly 5,000 suppliers, and they have a 57-day DPO. So what we want to do is establish the two bookends, sizing the prize on both sides of that coin, right? The first side is a max cash scenario where we're looking to do a targeted terms extension campaign while we minimize the negative supplier health impact. The other bookend would be the max yield. This buyer has put up to $50 million worth of funding available. They've set their APR floor at 6%, and we're going to look at how much yield they could derive by deploying cash into their supply chain. And then we'll look at the blended program. And this is where we want to unlock working capital to fully fund that dynamic discounting program. And in this case, the buyer has set that floor a little bit higher at 8%. So let's take a look at the first option that this buyer has, which is just a pure terms extension, right? They could come in, they could look at unlocking about $124 million in cash across about $1.2 billion of that spend, getting the targeted terms extension. This doesn't offer them any discount yield, and there's no cash injected into their supply chain. For the max cash scenario with supply chain financing, we're looking again at the same targeted extension based on the supplier's sector DSO, their cost of borrowing, some other factors that we look at to determine what the appropriate suppliers are to extend and by how far. So again, they're unlocking $124 million in cash. However, in this scenario, we have third-party funding in the form of supply chain financing coming in, and across the short tail, mid tail, and long tail, we're injecting about $45 million worth of cash where those suppliers want to be paid earlier, either on their previous payment term or even earlier than that when the invoice is first approved. The other bookend, again, is the max yield, which is pure dynamic discounting. This buyer may have plenty of cash on hand and want to deploy it into their supply chain for that balance sheet efficiency that Nick was talking about. And optimizing the rates, we would look at putting about $42 million into the short tail with $4 and $2.5 million going into the mid and long tail respectively. That means about $48 million in cash deployed from the buyer to yield about $4.1 million annually in discounts. Again, we're not injecting any third-party cash, but this gives the buyer a good understanding of if they wanted to deploy as much cash as possible into their supply chain to maximize yield, what does that look like? Now, where we end up with most of our buyers is a blended program, right? There are some opportunities for some high-yield dynamic discounting, but they also want to unlock that trapped working capital, and they want to liberate that cash. And so what we look to do is inject some third-party cash via the supply chain financing side of the coin, and that should allow them to unlock that same $124 million, and they're going to deploy some of that back into their supply chain. In this case, they're deploying, about a little less than $40 million, and they're going to get a little bit less. Again, some of that discount yield was lower APR, and so with that higher ceiling of 8%, some of that is going into the SCF bucket, but the cash that remains in the dynamic discounting bucket yields about $3.5 million in discount yield. So those are sort of the three scenarios, right? The two bookends, and then what Polaris allows us to do is find that optimal point based on the buyer's cash targets, both unlocking and deploying, based on their liquidity thresholds. We're able to make recommendations across those 5,000 suppliers for what would be the optimal balance between those two. So key takeaways and next steps. We'll talk quickly through this and leave a little bit of time for Q&A. So the prize tomorrow will differ from the prize today, right? Oftentimes the CFO is walking into Treasury asking for a particular figure. I need to unlock $100 million in working capital for some specific project or goal. Now, next quarter or next year, that same CFO may walk in and ask for something different, right? The project went great. It pumped a bunch of cash into Treasury. Now let's go out and deploy that cash. So that's why we want to look at both bookends so you understand what's available to you, and then you can make those strategic decisions as each quarter goes by. So accurately size the cash that you can unlock and the cash that you can deploy today, so you understand what the limits are on both sides. And understand that your suppliers are individual companies which require individually tailored programs. With the financial environment changing today with interest rates and tax laws, those suppliers may be under additional strain, put their supplier health at risk, and you may want to ensure that you're offering them early payment options that help them manage their own cash positions. They also may be in a great cash position themselves, and they may be more conducive to a longer term, and so we want to look at that as well. So what are the next steps for you guys, some practical takeaways that you might be able to look at? You want to size your company's prize based on a couple of key factors. One is obviously your company data, and we talked about some of that at the beginning, both supplier data, invoice data, payment performance, and understand where there's latent opportunities in your supply chain. But you really want to compare that against the universe of real supplier behavior out there in terms of payment terms and early discount rates. And that's where E&Y and Taulia can really be a great benefit to you guys, is we have that wealth of data across hundreds of Global 2000 companies, across millions of their suppliers, and we can really give you insight into how they behave in the wild, if you will. You also want to create scenarios to assess working capital yield opportunities, as well as the unlocking working capital, the yield opportunities, as well as enhancing that supply chain health. You really can create some win-win scenarios, as we pointed out in the static demo, where we were able to extend that supplier from 45 days to 90 days while keeping their cost to carry that invoice the same. In fact, in that scenario, lowering it just slightly. and unlocking almost $2 million in working capital for the buyer. So that's the end. I'll turn it over to Amrita, and I'll ask her to MC the questions, and I appreciate your guys' time, and apologize for the technical difficulties.
Thank you, Vince. Thank you, Nick. Hope you all enjoyed it. And again, apologies for the audio, the fact that we lost Vince in between. But regardless, hope you have enjoyed it. Some of the questions that we have today. So the first question to Vince or Nick, how do Polaris capabilities compare to Tableau?
I can, this is Nick. I can go first and then hand off to Vince. So, I think it's a great question. You could add, how does it compare to, BI or other visualization tools as well? So I think, what we see out in the market is there are a number of visualization tools that all require some level of analytics behind them. And I think what I'm seeing with Polaris and from a market comparison is the analytics that are done through for most organizations at the using Tableau as the visualization tool are really insightful, but they're insightful using information generated from that organization alone, not necessarily the market and the trends that we're seeing through other transactions outside of your organization. So that's one area where Polaris and other AI-based tools are kind of pulling a little bit more than just what your universe is doing within your universe. It's really looking at all the other areas that supplier is interacting with.
Yeah, I would echo what Nick said there. The primary difference is the volume of data that you have to put through this, right? And when you're looking just at your own suppliers and you're trying to understand how would this supplier react to a change in their payment term, there's no background data for you to bounce that against. What's their average DSO in the marketplace? You guys could certainly go out and get some of that Dun & Bradstreet data and pour that into your Tableau analytics and try to take a look at that on a comparison basis. But where Polaris really adds a lot of value is in the machine learning algorithms, right? Machine learning is really about recognizing patterns. And unless you have that depth of data to pour through the algorithm, you're not going to see those patterns come through. And then you're really back to an anecdotal understanding of your payment terms, talking with procurement and understanding, hey, we've got 200 suppliers here that we want to extend terms on. Procurement says, ooh, we've negotiated those as hard as we can. We really can't push those suppliers any further. Well, understanding how they've reacted to those same types of payment term extensions in the past is really where the value comes in. So it's a combination of those two things. Number one, having an analytics engine directly connected to your ERP system and all your financial documents. And that's a lot of the value that Taulia adds is because of our deep ERP integration, you can understand down to the invoice level really, what those behavior patterns are across all of your suppliers, and then put those through the machine learning engine. So the analytics, the visual analytics piece is really only one slice of it. Hopefully that helped answer that question.
Brilliant, thank you. The second question we have today, how did Taulia create Polaris? What is it? How does it use AI? And why is AI important when comparing to, say, an auction where the rate finding is done that way? Again, open to Nick or Vince, whoever wants to take it first.
Great question. I'll jump in on this one since I'm the product manager responsible here. We believe that an auction model, will find the lowest rate available. If the supplier is intelligent, they'll try a lower rate with each invoice until they figure out what that threshold is that's really set by the buyer. So it's no different. You're just setting a floor rather than setting an initial offer rate. There's a lot of behavioral economics that suggest that setting that anchor point is crucial for a retailer's success in that instance. It's why eBay has, moved most of their business to the buy it now. They offer both the auction model and the buy it now, and the consumer by and large, takes that buy it now option. So we believe fundamentally in the philosophy of allowing the buyer to set those rates and those terms themselves rather than setting up an auction model. And so in order to do that, we needed that machine learning pattern recognition to understand across the billions of dollars of invoices that we offer, what is that behavior? When do they take those early payment offers? Do they take them all the time? Do they only take them, conditionally at the end of quarters or the end of years? And so that's really what we're using that AI or machine learning to do, is to always be analyzing those patterns that we see across all buyers and giving all of our buyers the benefit of that additional insight across other programs, across other rates with suppliers similar, and understand which of those supplier factors. Is it geography? Is it size? Is it credit rating? And the combination of those factors that determine that early payment behavior supplier to supplier. Nick, anything to add? Or?
No, I think you covered that well. It's like you mentioned, it's your product, and I think that is completely fair. And the other part about AI being important is not a lot of companies are using it yet today. So will it? I think today it's early stages, and machine learning is early stages, and the applications that it's been applied to are limited. And I think what we're going to see going forward is a lot more focus on, there's obviously going to be robotics and automation built into a lot of working capital processes, and I'm all for it, and we do a lot of that work. But there's also going to be, as it continues to evolve, AI built into these processes and machine learning built into these processes in a way that extracts even more value that is just going to continue to evolve. So that's the only thing I think is even more interesting about the future, is what we're going to be able to come up with next.
Yeah, that's a great point. I'll just add one other thought to that, which is we're in the early stages of this, and when people talk about artificial intelligence, it's a spectrum, right? And so what we're doing today is not necessarily the automation piece. Polaris is not making decisions for you. It's not changing any of your suppliers' payment terms. It's not even changing the offer rates automatically. What it's doing is it's recognizing those patterns using our machine learning algorithms, and it's making recommendations to you at a level that makes sense, right? Again, you can't analyze on a daily or monthly or even quarterly basis all 5,000 of your suppliers. And so it really gives you that benefit that there is an algorithm in the back that is constantly doing that analysis for you and presenting recommendations. And then based on your additional insights, your cross-team collaboration between AP and procurement and treasury, you take those recommendations and you do what's right for your business. So we haven't yet gotten into the automation part of what Nick was talking about. There's no robot in the background that's actually executing any of these recommendations. It's really taking advantage of what's available today in terms of machine learning. And we use AWS and some of the same machine learning algorithms that they use to price their products in order to recognize those patterns and price things most efficiently to optimize yield and, again, unlock as much cash as we can.
Brilliant. Thank you very much. So we are almost at time here today. So again, thank you so much for your participation today. If you want to become a working capital game changer, gain true visibility and actionability into your company's cash opportunity, and build programs that actually scale across your supply chain, take EY and Taulia on their offer to help you accurately size the price. And we will be in touch with you with the next steps shortly. So with that said, thank you again for your participation, and we look forward to seeing you next time. And thanks to Nick and Vince. So with that, take care.